Hello folks, welcome into today's video. It's a bit of a serious one here today. I have a warning for all investors on what is coming. We're going to go through it all in this video, and we're going to also speak about how to position your portfolio to best manage through what's about to happen here, okay? I spent the weekend going through a lot of data, and I thought I needed to do a very in-depth video today and showing you guys exactly what's going on here so you're well prepared. I always want to make sure the folks that watch my channel are as prepared as possible, because if you're prepared for what's coming, you're not as likely to freak out, make poor investment decisions, make poor financial decisions in general if you're very educated on what's about to transpire here. And so I'm going to take you through step by step exactly what's going on here, how this has ramifications for the stock market, the financial market, and the economy, and how to position for what's about to transpire here. So it's an extremely important video here today, okay? I mean, like extremely, extremely important. I hope you guys really enjoy this one. All I ask in return is smash that thumbs up button, okay? Smash that thumbs up button, Hulk smash style. We're going back to Smash Factory. Make sure you subscribe to the channel, folks. I want to dive straight into this, okay? So where I want to start here today, okay? By the way, did you hit that thumbs up? Did you hit the subscribe button? That's all I'm asking. It took a lot of time to put this one together. I hope you did that for me. I hope you did that for me. I appreciate it, okay? I'm going to start here taking you through my investor report. Basically, we put this out to all the private group members each and every Friday, okay? I want to take you through a few important things. So AAI investor sentiment has been in a place where it's slowly starting to deteriorate here. If we look back 3 weeks ago, we were at about 46.5% bullish. Last week, down to 45.9%. This week, down to 43.2%. Now, not just we're in sort of a downtrend here for the bullishness, but clearly bearishness has started to peak up again, right? Now, keep in mind, if we look at historical averages, we are still very bullish as an investor group, right? And this is a survey that goes out to tons of investors each week on if they're bullish, bearish, or neutral on the market. So we're still not even close to being where obviously bearishness usually is, which is 31%, right? Bullishness is still far above, I mean nearly 6 percentage points above where we are usually at. Now the other important thing I want to draw to your attention here is if you look at the 1-year bullish high for AAI investor sentiment versus the 1-year bearish high, right? These were only a little over a month apart, which shows you how quick things can turn. Now, that is so important for everybody watching this video right now, right? Because if you look at the last year and a half, things have felt very bullish overall, right? But remember, things can change so quickly the other way. In a matter of 1 to 3 months, things can go from everybody feeling great about things to suddenly people feeling horrible about things in relation to the stock market. It happens quick. I mean, really incredibly quick. If I was to take you back to AAI investor sentiment back in 2022, it was fascinating how quickly at the beginning of the year the market went from bullish to bearish, and then by the end of the year went from super bearish to actually very bullish, like in a matter of a few months there. It can happen fast, folks, okay? Very, very quickly. Now, if we look at the CNN Business Fear and Greed Index, that's been in greed territory for quite some time. This is nothing new. Like, we've been in greed mode for quite a while. Market momentum, stock price strength, extreme greed, stock price breadth is in greed mode. Call options, obviously, have been in that as well. The only thing we haven't had is really market volatility. Economic indicators, we have a few worrisome things here. If we look at the Michigan consumer sentiment, which I think is always an important thing to look at out there, right? If we look at that here recently, 76.5 in March, right? That was actually down from February. So sentiment from consumers actually deteriorated a little bit. Now, we're up huge year on year, but it's not great to start to see a deterioration in consumer sentiment. If that continues, right, that's something to definitely be aware of, and that's not great news, right? Inflation edged up, as we know, to 3.2% in February, right? Also not great to see. Atlanta Fed GDP now actually just got revised a little lower, down to 2.1% from 2.3% the previous week. So not ideal, right? If you look at small business optimism index, right? Look at this. So the small business optimism index decreased in February to 89.4, marking the 26th consecutive month below the 50-year average of 98. So small businesses are still not feeling good out there, right? And it actually deteriorated in terms of their optimism here recently, which not great to see, right? Now, meanwhile, existing home sales recently were up quite substantially, up 9.5% in February. Now, you might look at that and you might say, oh, that's great, home sales come back. Well, you could also look at that as bad, because if home sales start to pick up substantially again, that means pricing could pick up as well, which leads to inflation problems, right? Home builder confidence was also up very nicely as well, up 6.25%, and that's up about 16% versus this time last year, right? Which is a good thing to see on one hand, like, oh, home builders are feeling good. On the flip side, that could also be seen as a negative thing. It's a bad thing, because if home builders are feeling great, then they're probably going to be able to charge higher and higher prices, which leads into what? Shelter inflation, right? Which is obviously a problem for us. Now, if we look at truflation numbers, they obviously have us substantially below where the government has us at. But the troubling thing is there has been a pretty significant uptrend here recently, and it looks like a pretty consistent uptrend as well. It doesn't look like it's just some, like, random, like, oh, we're up. I mean, it's a pretty consistent uptrend as of right now. If we look at gas prices, which matters to a significant portion of the population, because most people still do not drive EVs as of today, right? If we look at gas prices, they're up versus a year ago, and they're up substantially versus a month ago. And that goes for regular, mid-grade, premium as well. And remember, we're not even into summertime yet. So we'll see what happens with gas prices as we get into summer. Geopolitical conflicts, things like that could obviously spike gas prices in a more substantial way. This is GSG, Commodity Index. I was looking at this and I got a little scared. I'll be honest with you guys, okay? GSG, which just looks at a basket of commodities in general, I think is one of the most important things to look at if you want to judge if if CPI numbers are likely to rise down the road or fall down the road. When GSG started its big downtrend in 2022, that meant good news was going to come on the inflation front down the road, right? And it did. And we've been feeling the effects of that. We've gotten down to a 3 handle on obviously CPI numbers. But recently, GSG started to go up substantially. I mean, GSG is up almost 9% here to start the year, right? So this is a little worrisome, because this means there's a lot of commodities inflation that is starting, which can, at the end of the day, pretty much everything you make comes back to commodities. So that ends up causing problems down the road. 3 months from now, 6 months from now, 12 months from now, the consumer starts to feel it in a more substantial way, okay? Now, if we look at oil prices, right? Oil price already up over 14% here to start the year, right? We're only in the 3rd month of the year. So what's going to happen this summer? What happens over this next 2 to 3 months in regards to oil price? I don't like the trend. I'll put it that way. I do not like the trend at all. Meanwhile, we have consumer companies, some of the most important consumer companies in the world, to really gauge like how the consumer's feeling. Are they spending money? They're not doing too well, right? Nike's already down about 13% here to start the year. Lululemon's already down 23.5% here to start the year. The big daddy of them all when it comes to consumer business, Apple, people don't seem like they're out there buying iPhones left and right and iPads and those sorts of things. I mean, down nearly 9% here to start the year. And this is during a good stock market. So keep in mind, these stock prices you're seeing from a lot of these consumer names, if we were in a bad stock market right now where the indexes were going down, Apple would be down 16 to probably 25% right now. Nike would be down 25% plus, and a Lululemon would probably be cut in half right now, down 50% here to start the year, if we were in a bad stock market. But because we're in a great stock market, it's a little bit masking the actual weaknesses that is going on in a lot of these consumer-related businesses, right? If we look at FedEx's recent numbers, those came out this week, right? FedEx reported revenue down 2%. And the real thing that helped the business, you saw the stock price go up, but that was really because of fuel expense. Helped them out. It bailed the company out, which is troubling. That the company's EPS got bailed out by a fuel expense, which could easily be completely reversed 6 months from now or 12 months from now, right? And revenue that's down, you never want to see companies like UPS, FedEx, railroad operators, things like that. You never want to see their revenue down. That's usually actually a very recessionary thing, okay? We'll call it that. If we look at job openings, which I think is extremely important to look at, right? It's clear as day job openings have been going down substantially. And I mean substantially, right? Now, we're still in a relatively good place when it comes to job openings. There's still a lot of job openings out there, but there's a lag on this, right? This is looking at January numbers, and in general, these numbers usually lag, right? And so I don't know if there's really that many jobs out there right now. I'm just going to put it like that, right? I think the jobs market is still healthy, but I don't think it's as healthy as that job openings number looks there, right? And keep in mind, in regards to job openings, it can go from great to bad very, very quickly, right? In a matter of a 1 to 2 year span, look at the great financial crisis. I mean, it was looking like job openings were great. Oh, there's going to be no recession. And then boom, I mean, job openings absolutely plummeted to a little over 2 million openings there, right? That's how bad things got in that situation. Obviously, you've seen what's happened to job openings just over the past 18 months. And who's to say where that's going over the next 18 months, right? So the moral of the story this far is commodities are flying, which is bad. There's no way of looking at that and saying that's good, that's bad. Home sales are coming back, which could be seen as a good thing. It's like, oh, maybe it's a healthier economy. It could also be seen as bad because that could make prices go higher, which causes shelter inflation to be higher, right? Investors are very, very bullish right now, which could be seen as a good thing. They're feeling good. It could also be seen as a bad thing, as in like, oh, you know, maybe they're not prepared for what could be potentially coming. There's a growth narrative in the market, right? Growth stocks, very hot. Obviously, you look at things like Bitcoin, very hot, right? Which can be seen as a good thing, but it can also be seen as a bad thing, that it's setting us up for maybe a potential bigger crash if things go off the rails in terms of the economy. I mean, look at how bad growth stocks got hit and Bitcoin got hit without even facing a high unemployment cycle, right? What happens if you did have to face a high unemployment cycle to those sorts of things, right? CPI could go flying this summer if commodities keep running, which is obviously very, very bad. Government spending is insane right now, which could be seen as a good thing because it helps promote jobs and investment, but also be seen as a bad thing because it's inflationary, right? Insurance rates are flying right now, which is very bad. And then predatory lending, I think there's some predatory lending going on out there. I see some stuff on Instagram sometimes, some of these car salesmen and stuff posting on their Instagram accounts. They're selling this car to this person for like very small amount down, crazy interest rates. I'm just like, whew. I don't know, man. It feels a little predatory lending, and that's what I'll say out there in regards to that. So everybody's debating soft landing, hard landing, no landing, right? This is a whole debate out there. You watch CNBC, Bloomberg, anybody like that. I mean, that's all they talk about. Soft landing, hard landing, no landing. They've been talking about that for a while. I'm personally thinking about things a little bit different. I'm thinking about these two things. I'm really trying to figure out, are we early stage cycle, right? Is everything just going to get better and better over the next 2 to 3 years? Example would have been like 2010 through, let's say, 2012, right? That's a really good example in regards to that. Now, on the flip side, I'm trying to figure out, are we entering a 2 to 3 year cycle of stagflation? Stagflation, okay? And are we just starting to enter that time period of stagflation? Now, stagflation is a situation where you have GDP going down, right? Unemployment starts going up substantially, and then demand for everything goes down. But meanwhile, prices stay high, or companies feel like they have to keep raising price because their demand's going down, right? And it's a very ugly cycle to go through. And so those are the two scenarios that I'm really I'm not really thinking hard landing, soft. I'm just trying to figure this out. Like, because this completely changes everything. If we're early stage cycle here, then we're good for many, many years to go in the future, right? And I could see an argument for that. You know, 2020, what happened there, and then we basically had a recession in 2022. I could see us being early stage cycle. I can also see us maybe entering a stagflation cycle. And I'm going to say, even myself personally, I felt this. You know, like my Model S, I got the tires replaced on that recently. I mean, some of these prices are just shocking to me sometimes. $2,800? I mean, the $3,000 basically for 4 tires? Like, what are we talking about here? My friend was over this weekend, and he was saying, oh, you should probably get your tires replaced this year on the Model X, right? What's that going to be, $3,000+ for tires? Tires? Like, this isn't something that's going to be, like, earth-shakingly, like, game-changer to me. It's not going to help my net worth go up in any substantial way, I can tell you that much. So I'm going to spend $3,000-something just on tires? Tires? Like, what are we talking about here, right? I got a bid recently for a simple pool spa, little pool, little spa with a fountain to go in my backyard, $150,000. $150,000. I was talking with the guy from Toll Brothers over the weekend, and talking about pricing on a bunch of different stuff, right? And I was talking about my fireplace, because they still sell my fireplace in a lot of the higher end Toll homes, right? And I was like, you know, how much they get for that now? He's like, oh, that's over $20,000 now. Over $20,000 for that fireplace. When we got it, I think it was either 12 or 15, and I thought that price was ridiculous, but I was like, it looks sick, so I'm going to get it. Now it's over $20,000 at this point in time, right? Sushi. I went out for lunch with my family yesterday, sushi. hole-in-the-wall restaurant, my wife and me, and our 3 little kids, all our kids are under age of 10, right? It was $100+ at a little hole-in-the-wall sushi place. We didn't go out to some nice restaurant. We all got water. It was $100+. I mean, this is the type of stuff I'm seeing out there. And even myself, I'm like, dang, man, things are expensive out there, right? Like, it's kind of crazy. Texas Roadhouse, a stock I own, right? Texas Roadhouse announced recently it's raising prices for the 3rd time in under a year. Texas Roadhouse has always been known as a great value. Like, you go to Texas Roadhouse and you're going to get filled up with, good food. You're going to love it. And not everything's going to be the most healthy, but you're going to love it. And, and now I'm just a little worried, like, man, is Texas Roadhouse still going to be seen as a value moving forward? Drought has been causing beef prices to skyrocket. They're going to blame it on something. I mean, if it wasn't drought, they'd blame it on something else, in my opinion. The average retail price of beef has been hovering around $8 a pound, almost 25% more than before Rona, right? And that's something I look at and I'm like, geez, the price of steaks up almost 11% from a year ago. Beef prices in general up 7.7% from last year. Shoo! Chipotle. If I had $1 for everybody complaining about Chipotle's prices nowadays, I'd have enough to maybe buy some Chipotle stock for $3,000 a share, right? Chipotle says it may need to tick its food prices up to pay for California wages. So this is wage price spiral here, where, let's say Chipotle has a massive amount of their restaurants, obviously in California. California's minimum wage is going up substantially. And so you get in a wage price spiral where a company like Chipotle says, we're not going to eat that. Our consumers are going to eat that price increase. Okay, our workers have to make $20 an hour. Okay, our consumers will pay for that. We're not going to pay for that. That's not coming out of our margins. That will come out of the consumer's pocket. So then Chipotle has to go up on prices. And then wages go up. And then prices have to go up. And it's just like a wage price spiral there at that point in time, right? I saw this was fascinating. This was from 8 months ago. Somebody pulled out a receipt back from 2015. This is fascinating, man. And basically they're pointing out this is a 54% price increase on Chipotle from where the price was in 2015, what they were paying, versus obviously, 8 months ago, right? It was $12.65, now $19.50 for the same exact thing. Chips, guacamole, and a steak burrito. That's fascinating, right? Crazy when you think about 54%. I mean, 2015 was a good amount of time ago, but it wasn't that long ago. It wasn't even a decade ago. 54%? Jeez. Chipotle menu prices are going up again, marking the 4th increase in 2 years. So, yeah, you might think it's expensive. It's about to get more expensive when it comes to that, right? From what I'm hearing, insurance rates are going to be going up on everybody. Unfortunately, if you're watching this video right now, hate to break the news to you, but your insurance rates are likely going up 10 to 25% in the next 6 months, okay? I'm talking car insurance, I'm talking homeowners insurance, and I'm talking renters insurance. Health insurance, I don't have an in with anybody that has health insurance. If you have an in at health insurance, you know what's going on there, you can always reach out to me, okay? But from what I'm hearing, you're going to see your bills in the next six months or so go up 10 to 25% in regards to those categories right there, right? And I mean, you think about that. Let's say 15%. Let's say your car insurance goes up 15% 6 months from now, or in the next 6 months, and your homeowner's insurance and things like that, right? Let's say it all goes up 15%. The thing is, most people, the far majority of people, are not going to make 15% more from their job this year than they did last year, right? And so the far majority of people are then losing to car insurance, or then losing to homeowners insurance, to renters insurance, and these sorts of things, which is not a great thing, right? Because at the end of the day, that's just, basically stealing extra money from your wallet that you could use to invest. You could use that money to go out and spend in the economy and those sorts of things, but instead it's going on a need, which you have no choice. It's not like you can choose whether to have car insurance or not. I guess you can ride the bus or something like that and sell your car, but it's not like you really have much of a choice. Like, you got to have car insurance, you got to have homeowners insurance, renters insurance. That's all the stuff like you're forced to have, and yet the prices are going up 10, 15, 20, 25% on a lot of folks. And I mean, that's tough, right? That's tough. So we're in still an inflationary environment, right? We've had some things go our way, but I'm looking at a lot of this data. I'm getting more concerned about CPI numbers 3 months from now, 6 months from now, 12 months from now, right? That's a little food for thought in regards to that. Now, if I take you back to the Great Financial Crisis, there was a lot of ugliness that came from the Great Financial Crisis, right? But one of the few good things that came from the Great Financial Crisis is we set ourselves up for very low inflation for a long time. And actually, we experienced good amounts of deflation during the great financial crisis and as the years came out of that, right? If you go back all the way to 2008, all the way through 2016, I mean, you saw inflation rates at 1.1%, CPI 1.3, right? I mean, the highest number in that entire time was right here in 2011. We got a little high with inflation. We got up to 3.9 right there. 3.9 was the absolute highest we had. But most of that time, look at that time period. I mean, we were at under 2% the majority of that time, right? I mean, that's incredible. And so that was one of the few good things that came from the great financial crisis. And that's one of the things that, you don't be too scared of a recession and those sorts of things, because sometimes they get red and kill off this inflation that you're going through. And then you could have maybe several years, 2 years, 4 years, 6 years, 8 years of a lower inflationary environment, which is good for consumers overall, right? And I think back to myself working at Quick Trip with my wife now, but back then she was my girlfriend, and I thought about, how we made, let's call it maybe $100,000 combined together, right? And we were able to live a very good lifestyle on 100K, right? And I think about, man, I think it would be a lot tougher to live on 100K nowadays, right? I think it would, just because I can tell you things back when I was in my early 20s, I mean, there's a night and day price difference. It's not even close compared to what things cost now versus back then, right? So it's a little food for thought in regards to that. This is kind of the distribution percentage of household income in the United States. And if you look here, right, 62% of folks in the United States have household income under $100,000 a year, right? And these are the folks that obviously feel inflation the most, but they're also the folks that spend a lot in the economy in general, right? And so not great. And that's the folks that feel it the most. But the thing is, even if you're making $150,000 a year, $200,000, $300,000, $400,000, right? You're still feeling it. Even somebody like myself, you guys know what I got, and I still feel it. I'm looking out there, I'm like, $3,000 for flipping flapjack and tires? $150,000 for a simple pool with a spa and a little fountain? $150,000? So even somebody like myself's looking out there, and I'm just like, $100 plus for a hole-in-the-wall sushi place? Like, oh my gosh. It's no jokus, right? It's a holy smokus. So the risk is, at the end of the day, higher for longer. What I just took you through, that massive amount of data I just showed you there, which that was a lot of data we just went through. The moral of the story, what you should walk away, is higher for longer. I don't know when the Fed will lower rates in any substantial way. If they do end up lowering rates, it's going to be very small until we get a big recession, which means this higher interest rate environment that a lot of people thought was just going to be a very short-term thing. The more I'm looking at the data, the numbers, guys, it doesn't look like it's going to be a short-term thing. This looks like it's going to be a longer-term thing until the economy really breaks and until unemployment goes up substantially. And we can actually get rid of this inflation. Because until we get rid of this inflation, I mean, it's just going to be kind of a weight that is like weighing on everybody that is just a very ugly situation overall, right? So now let's talk about how to position your portfolio, given the fact that if you look at the data, it looks like we're going to be higher for longer. How do you position your portfolio in regards to this? Well, I'm going to take you through my portfolios in just a moment. I'm going to show you my portfolios and exactly how I position for this. But I have this little illustration sometimes I put over here. Today I got the 6 and 7 figure clubs over here, right? But I sometimes have this little, it's a silly illustration, but it's serious at the same time, because that's exactly how I think, right? Not just build a portfolio you're proud of years from now, but staying diversified is your alpha long term. I know a lot of people in the market, especially in big hype cycles, bull markets, they don't like to be diversified, and they set themselves up for just epic crashes when things happen that they did not see coming, whether it be high interest rates, high inflation, unemployment skyrocketing. Any of those sorts of situations can catch you way off guard, and if you're not diversified, you're going to lose epically. And it's going to likely take you years, not months, years to get back to just where you were, right? Growth, value, dividends, hedge, cash. There's another big thing I preach. GVD, right? You've heard me talk about it a million times in the past. Growth stocks, value stocks, dividend stocks. Everybody and their grandma, when the market's already gone through a massive bull cycle, they all want to just buy growth stocks, right? Because those are the ones that have made so much money. Listen. You've got to stay diversified in this thing. You've got to understand value stocks and dividend stocks. Those ones can do a lot for your portfolio over time. Growth stocks are phenomenal when you're in a big bull cycle, when the Qs are flying, and when Bitcoin's flying and all that stuff. It's great, right? That comes and that goes. At the end of the day, value stocks and dividend stocks can help you ride out those time periods of a year, sometimes several years, where things aren't really happening for those growth stocks, because growth stocks can go through several years of down cycles. A great example of that, right in front of everybody's eyes, is Tesla. Tesla stock has gone nothing but down pretty much for 3+ years, right? That's a perfect example. This can happen to growth stocks, even the greatest growth stocks, which Tesla would be on the Mount Rushmore of greatest growth stocks in history, right? And even that one has gone nowhere but down pretty much for 3+ years. So you got to understand, if your portfolio only consists of growth stocks, you could be down massively for years and years and years, right? And also, sometimes growth stocks don't work out. We all know that, right? And so that's just a little food for thought in regards to that. So having some cash around, understanding hedging, making sure to diversify is very, very important. I'll take you through a couple of my portfolios here and show you what's going on, right? And there's a public account. $2 million plus in this portfolio now at this point in time. Started this portfolio probably 6-7 years ago. Now at this point in time, the private group, they've been able to see every single move I've made in the history of this portfolio, right? And you look at the portfolio overall, it's a masterpiece. Meta represents growth stock, but also is a value and dividend play as well, right? Tesla represents growth. PayPal represents value. Elf represents growth. Amazon represents growth. And Palantir represents growth. Then you have Revolve, which actually right now represents more value. You have Cheesecake Factory, which is a value and dividend play. You have Nike, which is a value and dividend play. You have Nvidia, which is actually a growth and value play right now. And I know some people wouldn't think value. Just look at the valuation. Tell me that forward P and tell me that future revenue growth is not value. That's value to the max. You got Fubo, which is a growth stock. You got SoFi, which is a growth stock. We have Planet, which is a spec play. And then I got a couple hedges in this portfolio as well, right? If we look at the Patreon portfolio here, I mean, look at this. Got a value stock, value dividend play, growth. Meta, once again, is a GVD. It's growth, value, and dividend play. You got a value in Revolve there, value in Nike. Texas Roadhouse is a value plus dividend play. Tesla's growth. Wynn is value and dividend. Shopify's growth. Fubo's growth. SQQQ is a hedge. If we look at Avant, that's a spec. And Toll Brothers hedge there, that's a spec as well, right? And so I take you back to this, staying diversified is your alpha long-term. Growth, value, dividends, hedge, cash. Be prepared for any market, right? Buy the dip, never trip. Be prepared for any market. Be prepared for stagflation. Be prepared for recession. Be prepared for a great economy and things just go up and up and up and a melt up, right? And when I look at my portfolios overall, I'm ready for whatever. You know, throw stagflation at me for the next 2-3 years. Okay, we'll handle that. Throw a recession. We'll handle that. Throw a great economy. Throw a too hot economy. Throw inflation. Like it doesn't matter which way you slice it. I'm going to be ready for that. Got the cash there. Got hedges on. Got growth stocks, value stocks, dividend stocks. There's nothing worse than a feeling of if the market goes one way, you're screwed, right? If you're super bearish and you just have all short positions on it and put options, you're scared, you can't sleep at night because you're like so paranoid about the market going the other way, right? And just keeps going up and up and up. On the flip side, if you're bullish and all you own is a few growth stocks and you're 100% invested all the time, you don't know how to hedge, you don't know how to keep some cash around, you don't know how to value stocks or dividend stocks, and you don't even know how to value growth stocks. Because if you don't know how to value stocks and dividend stocks, you don't know how to value growth stocks. You're just throwing money and gambling out there, right? And if you're doing that, you're setting yourself up for a lot of problems down the road. I mean, a lot of financial problems. And so you got to understand all this stuff on a very, very high level. And I teach all this stuff right inside my private group. I mean, if you've never applied to join in there, why haven't you? I'll just be honest. Why haven't you applied in there? That's a pinned comment down there. Click on that. Apply to join us in there. All the private group. Do you think it's just luck on having that many people go through the private group over time, all those course curriculums, and reach 6 figures, 7 figures, and beyond? And it's not just luck behind that, I can tell you. It's going through all those course curriculums, understanding when you're getting ripped off on a stock, understanding when you're getting a good deal, understanding how to construct portfolios, understanding all the stuff you need to understand to actually build a great portfolio that's lasting for the next 5-10 years that you're going to look back at and be like, I'm proud of myself. Not like the next day, like, oh, my stocks went up, I feel good. Oh, my stocks went down, I'm panicking, should I sell? No, okay. All right, guys, appreciate you joining me. Much love as always. Hope you enjoyed today's video and have a great day.